Howdy, hey, and hello there. Welcome to another episode of Weird Finance, where we try to help you feel a little less weird about money, one conversation at a time. I'm your host, Paco de Leon, and on this week's episode, I'm chatting with Robert E. James II and Stephen H. Gordon. I'm happy to be living in such a progressive time, a time when being a woman doesn't limit my access to banking or credit cards. But even though progress has been made, of course, we have a long way to go. The racial wealth gap continues to be significant. In 2019, the median net worth of a typical white household was $188,200, which is 7.8 times greater than that of a typical black household, which was $24,100. Now, you might be wondering, how can institutions and individuals help close this gap? Well, it so happens I have recently learned about minority deposit institutions. Minority deposit institutions, or MDIs, are banks that provide access to banking services and deposits to minorities to help reduce racial inequalities. And that's what this week's episode is all about. I spoke with Robert E. James II, the chairman of the National Bankers Association, and Stephen H. Gordon, the CEO of Minority Deposit Bank, Genesis Bank, to learn all about how MDIs are playing a role in closing the racial wealth gap. So please enjoy my conversation with Robert and Stephen. I never thought that I would be so thrilled to speak to two individuals about our banking system, but you guys have done it. You guys have got me excited about learning more about our banking system and really educating as many people as we can in terms of letting them know what the National Bankers Association is, what minority institutions are, minority depository institutions are, and really like the impact for the world. So I want to start first with Mr. Robert James, the president and CEO of Carver Financial Corporation and the chairman of the National Bankers Association. Robert, what the heck is the National Bankers Association? Why does it exist? And what's its role in the banking system?
Paco, first, thank you so much for inviting me onto Weird Finance today. And it's a real pleasure to speak with you and to get a chance to learn about your incredible podcast, to talk to your listeners. The National Bankers Association is a 96-year-old advocacy organization. It was founded in 1927 specifically to advocate on behalf of minority banks, minority depository institutions. Originally, the NBA was called the Negro Bankers Association. It was founded by a group of Black bankers because they weren't allowed to join the American Bankers Association or their various state banking associations. And they recognized the need to work together to deal with challenges that they have in banking, to collaborate, to confer with one another about common challenges. The association then broadened its scope to include membership by other minority groups who own financial institutions, insured depositories. So we also now represent the interests of Native American-owned banks, Asian American-owned banks, Hispanic American-owned banks, multiracial owned banks, multiracial banks owned by minorities, as well as women-owned banks. And so we have a broad tent, but we advocate on behalf of those minority depository institutions that serve underserved communities.
Beautiful. I have a maybe deeply and profoundly ignorant question, but are all banks required to be part of a National Bankers Association?
No. It's a membership organization, like similar to the American Bankers Association, or the various states have their own banking associations, and you pay, the banks that are members of those associations, just like the NBA, they join it, they pay dues, work together with each other, and we have conferences and meetings, and now in these days and times, we have lots and lots of Zoom and other kinds of online sessions to educate our bankers and give them access to information and allow them to work together and collaborate.
Sorry, Robert, I think I misphrased that. I meant in order to be a legitimate bank in the US, do all banks have to be a member of some sort of association, or is that it's not compulsory? It's just something that they would like to be a part of?
Sure, it's not compulsory. No, you don't have to be a part of a
Okay.
banking association, but pretty much every bank is a member of at least one, and frankly, most banks are members of multiple banking associations. Our bank is probably we're a member of the MBA, of course. We're a member of the Community Development Bankers Association, the Georgia Bankers Association, the American Bankers Association, and there's different things you get out of being members of all these different associations. And so, but the biggest thing is you need to be a part of these groups in order to network with other bankers. There's sort of strength in numbers.
Got it. Okay. I think I'm piecing together my understanding of the banking industry bit by bit. Thank you, Robert. I would like to know, can you explain to the listeners exactly what a minority depository institution is and what's the unique role that they play in the financial services industry? What are these banks known for?
Sure. So minority depository institutions, or MDIs for short, are actually defined in federal law. They're institutions that are owned or controlled and primarily serve members of minority communities. Specifically, there's a statute called FIREA, and that was passed in 1989 as a result of the savings and loan crisis, something that happened probably, Paco, before you were born. And the FIREA law was a law that was passed to further regulate financial institutions. And in Section 308 of that law, there's a definition for minority depository institutions. And each regulatory agency that governs banks, so the FDIC, the Federal Deposit Insurance Corporation, the OCC, the Office of the Comptroller of the Currency, the Federal Reserve, as well as various states that also have their state banking regulators, adhere to the definition of minority depository institution that was set into federal law by FIREA Section 308.
I love it. Of course, the Harvard Law School grad is referencing the law directly. I appreciate that. Okay, another silly question. Do MDIs exclusively serve minorities? And if not, why would somebody else want to bank with an MDI? What impact does banking with an MDI have?
It's a great question. The answer is no. Our institutions are banks just like every other bank. We have to have FDIC insurance, and we have to govern ourselves just like any other depository institution. And so our banks are open to anyone, regardless of race or gender or religion or sexual orientation or any of those other kinds of categories. However, it does make a difference to have banks that are owned and operated by people of all kinds, and specifically in minority communities where there's been historic exclusion from the financial system. It's really important to have institutions that are owned and operated by people from those disadvantaged groups, so that that focus on those groups to make sure that they're getting a fair opportunity to access capital and credit.
Beautiful. Stephen, I would love to switch the conversation over to you and lob a question at you. Mr. Stephen Gordon, I'd love to know a little bit about you. What has brought you down this road of wanting to serve a community and working for a multiracial institution?
Okay. Well, first, let me back up, Paco. Thank you for including me in your podcast. I think this is very important to be able to share the work that we do with your audience and with the communities that we all serve. Second, I launched Genesis Bank on August 2nd of 21. So 2010 was when I launched Opus Bank, which was the bank prior to this. And third, I'd like to also say that it's very difficult to follow Robert James and his highly articulate Harvard law background. So I'll do my best to hold up my end of this. But thank you. So I've been doing this in one way or another since I was about 21 years old. Now I'm 60. And I thought I knew everything at 25. And then at 30, I realized I knew nothing at 25. And at 40, I realized how little I knew at 35. And it just keeps going that as life evolves, hopefully you learn more and the reasons why you do things evolve and everything has a different meaning. And this is the third bank that I've launched from the ground up and capitalized. And each bank really was very impactful, but this one is extraordinarily intentional in the way that we go about doing what we do and the difference that we make in our communities. And some of that has to do with the market that we're in, meaning the Southern California market is anywhere between 60 and 75% majority minority population and is very heavily populated in terms of the demographic, second largest demographic in the whole US after the New York tri-state area, and is predominantly African American, Asian American, Hispanic American. And ironically, we're one of only two diverse multiracial MDIs in the entire US out of what, Robert, about 143 MDIs now that exist?
That's correct.
And I thought it was really important when founding Genesis that we were reflective of the communities that we serve. How could I go and start an institution that is in a market that is 60 to 75% majority minority and have it not be an MDI? And how can I have it focus on predominantly one minority ethnicity when there's such a heavy distribution of diversity here in Southern California and such a robust market that the institution must be reflective of that diversity that exists here in Southern California. So hence, again, why we're a diverse, multiracial minority depository institution, which means that by definition, if there's only two of us in the country that the other 141 predominantly focus on one ethnicity group, which may work in some markets, because every market is different. But here in Southern California, with how diverse the market is, I thought it would be really hypocritical if we were only focused on predominantly one ethnicity group. But Robert put it very well, which is MDIs at the end of the day are a bank. And we do boring things like bring in deposits, make loans, and and the like. But we as MDIs, I think, by definition, are extraordinarily intentional about the impact that we try to have in our low to moderate income minority communities. By definition, otherwise we wouldn't be MDIs. So our board is reflective of the community. 4 out of 7 members of the board are representative of the same diversity that we have in the community. Our executive team is equally as diverse. Our senior management team and the entire team here is equally as diverse. And I think as an MDI, we're probably about 3 times as diverse as the rest of the banking industry based on data. We actually lead from the top of the institution as an MDI, reflective of the community, impacting community right on through the entire institution. And the fact that there are, 4,800, 4,900 banks in the country, I always say that if someone doesn't believe in the mission that we serve here in the communities that we serve, there are 4,800 other banks that they could choose from to go get a job at. Here, you got to be really passionate about the impact that we're having.
Of course, if you're in a diverse market, there's lots of folks that need to be served. Why wouldn't you structure your organization so that it's helpful to them? I'd like to know, what are some of the opportunities in serving the community as an MDI?
Well, I think that being positioned as we are, again, going back to that being one of only 2 diverse multiracial MDIs in the country, with the other one being in New York, and that's Piermont Bank, that here in this market in Southern California, and also at this time where there's so much social change going on in across this country, and with bank, the word bank now being a 4-letter word, at least it started to be more known this year that way. I think that a lot of people out there, whether they own a business or whether they're a family or whether they're an individual, they're seeking out something more from their banks than they used to, and they're looking for ways to make a difference themselves, and to bank with those that maybe understand what the decisions are, the challenges are that they have every single day in the capacity of running their business or managing their family's finances or whatever the case may be. And what we're seeing is that there's an affinity in the marketplace for what we're doing. And, as much as we may market, a certain amount of that is extraordinarily organic, and a large amount of it is organic. And people are gravitating towards Genesis as being a diverse, multiracial MDI, and feel like that there's a team here that might be able to relate to them and their challenges and their worries at 11 o'clock at night, in many of the same ways that inside the bank as they worry about it outside the bank.
How do you approach immigrant families or families who have historically been underserved or even exploited when it comes to home ownership. What is going on inside of these organizations to help confront that reality and to change it moving forward?
I like to say that we lead with brain power, ideation, solutions. We lead with financial literacy education, with mentorship, with technical assistance. When you start talking about immigrants, you may be talking about a second generation family owned business, for instance, where the first generation came over from, I'll use the example of Vietnamese immigrants that came to the country in the 1970s, escaping oppression, came to America, started a business, didn't really have an understanding of how business is run in the United States, didn't really have the education to be able to run a business, very much kept the money under the mattress, so to speak. And then the second generation, born in America, educated in America, within the educational system here in the US, and views it from a different lens. So again, we try to lead with that idea generation and the mentorship and the financial literacy education, because some of those startup businesses, early stage businesses, family run businesses, quite often what they need is that education. And that education can open the door towards opportunity. And as that business matures, where they're running the business with actually keeping good books and records, where the previous generation never really felt a need to do that, perhaps, or didn't have a means of doing it, and didn't really have access to the banking system, and all of a sudden was being taken advantage of by what many call the shadow banking system, or the non-bank bank-like entities that start gouging the family or the business. We try to get them to where they're able to access the banking system and have that opportunity that maybe the previous generation did not have, which all of a sudden can mean that business can thrive, whereas the previous generation had many challenges.
Do you mind if I comment on that, Paco? I think Steve made some really excellent points, and I'd like to elaborate on a couple of them. One of them is that I think you see very similar trends in a lot of underserved and disadvantaged communities. And one of them that Steve highlighted is the need for increased financial education and acumen, financial skills. I think that when people are shut out from the legitimate financial services system or feel that they're not welcome in that system, there's a cascading effect, and it impacts your ability to understand how to maneuver within that system. And so you see small businesses that oftentimes can suffer because they don't have an understanding of exactly how to manage their books and records. And so a lot of MDIs really focus on that financial education and providing skills to their customers, whether it be for small business or home ownership or just personal finance. I know on our bank's website, we have a personal finance curriculum that you can go through and just learn personal finance skills. And we do a lot of outreach and seminars in that space. The other thing that I would emphasize is that financial services exist in every community. They exist in every community. The question is whether they're legitimate or mainstream financial services or not. There's no way you can survive in America without financial services. So someone in your community is making a loan. Someone in your community is taking and cashing those checks. Someone in the community is helping you when you can't make a rent payment or a car payment. The question is it in the legitimate regulated financial system, or is it unregulated or perhaps predatory? And so one of the key things about being in America, in this capitalist system and free enterprise system that we have in this country that gives such vast opportunities to individuals, is that you have to have access to financial services. You have to have access to capital and credit. And it always exists. The question is whether it's in your neighborhood or not. One of the things that's really interesting about minority depository institutions is that if you look in underprivileged or underserved neighborhoods that are predominantly minority, MDIs, 77% of MDI branches or minority depository institution branches are in minority communities. And oftentimes they're the only federally insured depository institution in that community. If you go to a neighborhood where there is an MDI, people there have 3 times more likely to be able to have a home mortgage. they're more likely to be able to get a small business loan. If you go to a neighborhood where there is no MDI, then there's a lack of access to capital and credit in a legitimate way, which exacerbates racial other wealth gaps that exist in the United States.
But Robert, I'd go even further than that, and it's something that you and I probably see every day. If you get to where somebody actually understands somewhat how the system works, the banking system, and they do figure out how to navigate their way through the banking system. So I'm taking off the table for a second the non-bank, perhaps predatory related, less regulated institutions. And I'm now talking about, let's say for the sake of this discussion, you've got two people who have got access to the banking system. The experience could still be completely different that those two people have, because the one who is more sophisticated, educated, and has the knowledge of how the system works, they're going to actually figure out how to gain access to Robert or to me or to our best bankers. Those who don't really know how it works, they're going to walk into a branch and they run a business and they went into a branch and they get a teller. And the level of sophistication that they get, the skill set that they get, even inside of the same bank, might be different, because the person who runs the business needs a different type of level of sophistication. And if all they do out of convenience and out of a lack of knowledge of how the banking system works, they walk into a branch, they're not going to necessarily get the best of our bankers. They're going to get probably our lower paid employees who don't really know how business banking, commercial banking fully works. And they're not going to get the level of service and knowledge and experience that they really need. So even once you get access to the banking system, it doesn't always work the same way for everybody within there. So the knowledge and experience and sophistication, the obligation that Robert and I have within our respective institutions to be able to spread that knowledge and experience in our communities and make sure everybody understands, what it is that we really do for a living and how it all really works. I think we have that responsibility as well.
Steve, one thing that you said that was so important to emphasize is the importance of relationship. And that's one of the things that we learned during the pandemic, during the PPP loan crisis. A lot of small businesses had money in large financial institutions, the biggest of the big banks. It's where they had their depository accounts, but they couldn't get service when they needed that PPP loan to keep their business open. And it's because they didn't really have a real relationship with the banker. They had a relationship with a website, and that website didn't pick up the phone and call them back, or their bank account wasn't big enough to meet the requirements of their large financial institution to make that PPP loan. And so many businesses suffered during the pandemic because they couldn't get access to those first two rounds of PPP. And it was MDIs and other mission-driven lenders that really stepped into the breach. And it was because you could build a relationship with a person. And so it's really important that you have institutions like ours that are in the community, but not just in the community, they're of the community that you're trying to serve, because we're more interested in having a full relationship with our customers.
And the timing couldn't be more relevant. And I say that because the genesis, I wish I had $1 for every time I say this or someone else says it, but the genesis of Genesis came out of, the pandemic. The previous bank that I had built was acquired January of 2020. Pandemic hit March of 2020. And as far as I was concerned, I was done. I mean, the previous bank was bought and, I found peace and quiet. And then all of a sudden pandemic hit and I'm receiving phone calls from all sorts of previous clients who said, we don't know how to handle this. Our business is under stress now. The world is getting shut down. We're all being told to go home. And there's this PPP thing out there, and we don't know how to navigate the SBA. We don't even know how to navigate the bank. Was just acquired, and we can't get a phone call back. And all of a sudden, I'm hosting calls on this new thing called Zoom with 250 business owners at a time, helping them navigate their way through the PPP, through the SBA, and through their bank. And I realized that was just a microcosm of the problem that was happening across the whole country. And I realized that, that it was so necessary, recognizing that every single time we have an economic crisis, an economic moment that occurs in this country, all the rest of the banking system has a tendency to become incredibly internally focused, cleaning up their own mess, and they push clients away. And whenever that happens, businesses get left behind, small businesses, family-owned businesses get left further behind, and then the minority-owned businesses are left even further behind. So the role that MDIs play, recognizing where we are in this economic cycle now, is even more critically important than it probably ever has been. And we're already seeing, look what's happening. We've had a few banks fail this year that were very large banks. They had to focus incredibly, intensely internally on cleaning up the mess that they've created. There are still many more banks like that across the country that are internally focused, dealing with their own mess. And we can almost call them zombie banks or whatever. While the MDIs are really intensely focused on making a difference in our communities. And the need is probably greater than ever before.
I absolutely agree. One of the things that I was reading about when I was looking into the National Bankers Association is this mission that you guys are on, and it's to eliminate the racial wealth gap in America. And from all of the things that I hear you both talking about, how these banks operate, how these MDIs operate, I can see, how that can move the needle 1 degree. But Robert, I'd love to hear more about, what that means from an association perspective and how that trickles down to the banks that you serve.
Sure. The racial wealth gap is a pernicious problem in the United States. It's existed since this country's founding. At the end of the Civil War, the average Black family was worth about 1/100th of the actual value, the net worth of the average white family. And that's because most African Americans at the end of the Civil War were just being released from slavery. So they were literally, most African Americans were actually part of the wealth that was owned by certain white families, very privileged white families in the United States. And so in a pretty quick period of time, relatively speaking, the racial wealth gap was reduced down from about, roughly 100 to 1 to like maybe 10 to 1. This is still a huge, huge gulf. One of the things that's been interesting is that since the civil rights movement, the Black-white racial wealth gap has actually started to creep further and further apart. In other words, Black families are actually worth a little bit less than their white counterparts across the board. Why is that? There's a lot of reasons, and we could have a much longer kind of, very academic kind of conversation for that, around that, to explain why. But why eliminate it? I think it's one of the things that's really important. Why do we have this mission to eliminate it? It's because it would be good for everyone. It would be good for the entire economy. A huge bank, Citi, commissioned a study that was published in 2020 that basically found that if you could eliminate the gap between the net worth of Black families and the net worth of white families in the United States, you'd add $6 trillion to the US GDP. $6 trillion is kind of an almost unfathomable number. I mean, it's so big that it's kind of hard to wrap your head around it. But $6 trillion added to the gross domestic product in the United States would improve everyone's life. It would mean more money for schools. It would mean more money for healthcare. It would mean more money in people's pockets. And so it's a really important kind of, I think, national goal for us to pursue eliminating the racial wealth gap. And so that's what the MBA is about. The MBA is really focused on that and helping the banks that we serve, the banks that are members of our association, serve their communities in pursuit of that goal, which is to make sure that everyone has an equal shot, an equal chance to participate in free enterprise, which will lift the entire country as we do that.
Hey, Frankie. I just came from talking to this guy, Sal. He spent time today telling me about this amazing new opportunity that's guaranteed to make us rich.
Charlie, you sound jazzed, but I'm always weary about get-rich-quick pitches. What's the gist of this supposed opportunity?
It's called a multi-level marketing company, and it sells essential oils. But the best part is that you can make money in 2 ways. First, by selling the oils, and second, by recruiting our friends and family to join and sell oil. We get a cut of the profits too.
That sounds a lot like a pyramid scheme. Have you done any research on it?
Well, no, but this guy I met said that he's already making thousands of dollars in just a few weeks.
I bet he's one of the top people in the pyramid, making money off all the new recruits. Charlie, eventually the pyramid collapses and everyone else ends up losing out. It's just not worth the risk.
Oh, I have no idea. I'm glad I have someone like you to looking out for me. Thanks for the warning, Frankie. Now I know.
And knowing is half the battle.
Weird Finance.
Weird Finance. Weird Finance. Weird Finance.
What are the obstacles your organization and MDAs are facing right now in executing on this mission?
The biggest obstacles continue to be access to capital. So interestingly, the communities that we serve have a lack of access to capital, but a lot of our banks have experienced a lack of access to capital. Minority depository institutions, Steve mentioned earlier, there's about 143, 144 some odd MDIs out of about almost 5,000 banks. So it's a very small percentage. We control, as total MDIs, control less than 3% of the total assets in the banking system in the United States, to give you an idea. And so our banks need more equity capital themselves in order to grow and scale. For every $1 of equity capital that's invested in a bank, the bank can roughly raise about $10 worth of deposits, which is your money and my money and other depositors' money, which is the cash and the liquidity that we use in order to make loans. And that's how we're able to generate wealth in communities, is to be able to take that equity capital and raise deposits and then make loans. So our banks need access to more capital. At this moment, fortunately, at the end of the pandemic, we've actually raised more capital in MDIs than we probably have at any time in U.S. history. And normally, speaking of African American owned institutions or Black owned banks in particular, usually when there's an economic convulsion in the United States, you've historically seen that we've lost roughly half of the Black-owned banks. This is the first time in American history where we had an economic convulsion like what the pandemic did and the shutdowns around the pandemic, and we're actually seeing a slight uptick in the number of MDIs. We've seen an increase in the number of Black-owned banks. At the beginning of the pandemic, there were only 19 Black-owned banks. Now there's 22. At the beginning of the financial crisis in 2008, there were over 40 Black-owned banks. At the end of that crisis, there were only 19 left. And so we're actually seeing new capital and new banks getting started, which is fantastic. But we now need more deposits. We need low-cost, long-term deposits, really from impact-driven investors, people who are not looking for a huge return on their money, but really want to see impact in communities, which is what our banks deliver. And that could come from corporations, foundations, other large depositors, the federal government, that can kind of see the whole picture for what kind of return that we give to communities, not just in terms of a rate that we might pay them on a deposit, but also in terms of home ownership, in terms of small business lending, in terms of consumer lending, and the other things that we provide in communities.
I didn't realize that the term equity capital, and I'm going to show you my ignorance on banking. I thought, okay, let's get as many people as we can to join your banks, and hopefully that will move the needle. But it sounds like we need larger organizations and even the government to start, putting their money where their mouth is in terms of investing in these communities.
Well, we need both. And, one of the things that happened, kind of the twin incidents of the pandemic and the murder of George Floyd really led to an influx of equity capital for the first time into MDIs. There were programs that were established during the various stimulus bills that put some permanent capital into MDIs and other mission-driven institutions across the country, as well as some of the very largest financial institutions in the country made some very, very reasonable investments in particular in the Black-owned banks, but some also in some of the Hispanic and Asian-owned banks as well, to try to address racial equity issues in the various communities. And so that permanent equity capital is significant. And so it is good for us to have your listeners and other individual depositors and small business owners maybe take a look at the MDIs in their community, because they're looking for that relationship, and bring those deposits. We need those customers too. So we need both, but we also need those big institutional depositors to bring their money at low rates for long periods of time to help us make more loans in the community.
I have a question that I've been dying to ask some bankers. So I think you fellows are going to be the right people to ask. Okay, Robert, you said when equity capital comes in, let's just take $1. The $1 comes in. You said that you can effectively take that $1 and how many times can you give away that $1? I know this is going to get really abstract, but if you have a big organization that deposits $1 and it's going to be a long-term deposit, right? And the way that the bank works is they take that money and then they can lend it out to consumers like me. Would you lend out the whole dollar to me or would you only lend out 50 cents to me? Let's start with that question. Or maybe it's a different number that I don't understand.
Sure. Let me back up again and start from the beginning. So equity capital is like, if you buy shares in the bank, right? If you buy stock in the bank, and there's different kinds of stock that you can buy in a bank, but if you buy stock in the bank, that's equity capital in the bank.
Okay.
So that's that $1 that I was talking about that I can then take a deposit. I can go and leverage every $1. I can go and raise $10 in deposits. So your question is, what happens to that $10? So those deposits that come in, how many times can I recycle it? A portion of the profit that we make, basically in banking, the way that we make money is we want to lend money at a slightly higher rate than what we're paying to the depositor, and that's called a spread on the money that we have as deposits. And that's basically how banks make money. And so if we're paying you 2% on your deposit, we want to lend that money out at 4 or 5%. And as that interest income is being generated, that's going to generate more and more dollars for us to relend. And so it can really kind of be perpetual. There's almost really no limit to how many times we can recycle those dollars as you're repaying your loan because you've got great credit and you've got a great business plan and we know that you're going to repay. As you're repaying, we're reinvesting in more and more businesses or more and more home ownership opportunities, more and more people in the community who have an opportunity to borrow and repay. And so it can really be an exponential kind of growth.
Another way to look at it, Robert built the math bottom up. Another way to look at it would be top down. So if you're, let's say, 100 million in total assets, you've got to maintain somewhere around 9% capital, equity capital. So that difference between the 9 and the 100 or the 91 million must be comprised of deposits, and then the loans or sometimes investment securities comprise that same amount on the asset side of the balance sheet. It's less about how many times do I recycle the deposit.
Right.
It's that I've got to maintain a certain amount of capital cushion on the balance sheet from a regulatory standpoint, safety and soundness standpoint. And then everything else above the equity is going to be your deposits and your loans. We can leverage the equity around 11 times.
Whenever I really stop and think about this, it always blows my mind. It's like, well, we really have the power to create value and to really make a difference. And feels like the money is coming out of thin air. It always blows my mind.
When we started doing this, when the government came up with the program of how they wanted to be able to back MDIs, and they started talking to a lot of the large corporations out there about investing in MDIs, they started out by talking about putting those large corporations, taking some of their excess liquidity and putting them as deposits at the banks, at the MDIs. The challenge with that was that initially you can only have $1 of impact off of the $1 of deposit. You got $1 of deposit, you made $1 of loan, and that was it. And then they realized that if instead that dollar came in as equity, that we could have 11 times the impact on that dollar rather than 1 for 1. Now it was $11 of impact, but then you still need the deposits. And that all worked really well for a while until rates went up as high as they did. And then there were those people who were doing things for pure social impact good, who suddenly, regardless of how much that social impact meant to them, as usual, greed set in. And it was social impact to a point. Social impact was really good and acceptable when rates were at 2%, maybe somewhat acceptable at 3%. But then when the alternative investment became 5.25%, all of a sudden it was like, hey, how do I get that 5.25%? I care a little bit less about social impact. That's some of the challenge right now in the industry, which is we still want low cost deposits, but we're competing against U.S. government treasuries and 5.25% yields.
Yeah. Wow. I mean, that's really frustrating to hear that in a low interest rate environment, everybody's down for social good, but as soon as they can get a higher return, they want to yank their money out. But I think that just highlights the larger reframe that we all need to have, that of course, getting a return on our investment is important, but we can think about value and impact in other ways. And Yeah, I'm glad we're able to have this conversation and let people kind of lift up the curtain, let them understand how banking works and, why it matters where their deposits are. I want to ask you, gentlemen, what are your thoughts on, do you think we are going into a recession? Have we been hanging out in a recession? And how do you see MDIs and communities of color being impacted by potential recession?
All right. So I do think we're heading into a recession. The Fed has been fighting inflation, and they may push it a little too far, with these interest rate increases. The fact that banks are pulling back on lending significantly because they're fighting every day, battling, trying to bring in deposits or maintain the deposits that they have, and now cutting back on lending because you can't have your ratios and liquidity get all out of whack, could very easily drive a recession further. Plus, there's all sorts of challenges upcoming in commercial real estate that's going to be coming up for refinancing. And then, this high cost of inflation is impacting people in terms of, decisions that they're making every day. And as much as the Fed is trying to navigate a soft landing, we'll see how well they're able to do that. And I think we had the first leg of a hiccup, earlier this year, a few months ago, when, a few banks suddenly went under that were major banks. And there may be some future hiccups in other ways that are less related, but impact people's decisioning and their psychology all around this. How would that impact low to moderate income and minority community? I think, as I said before, whenever there's some sort of an economic cycle, minority community, minority owned businesses, low to moderate income communities, they get left further behind, and it has a greater impact. So I think there are going to be some real challenges ahead.
I think Steve is right. I think we are headed for what would technically be called a recession. It's very hard to predict when that's going to happen. The economy and consumer spending has been very resilient, very kind of resistant to these increases in interest rates by the Fed, and actually very resilient and resistant to inflation in general. However, I think that there's just things on the horizon. The rate increases are going to cause a slowdown in lending in many ways because of what Steve articulated earlier, which is the challenge that many of our banks have in accessing liquidity or lower cost deposits in order to continue to make loans. And so we're going to have to start to be much more judicious about which customers we lend to. The other thing about that is that you have to stress test, or at least you should stress, your loan applications, right? And so if a person comes in and applies for a loan and it looks like they can pay the loan back at the rate that we're charging today, we also have to see what happens if rates rise and see if they're going to be able to continue to make those payments. And so it's going to mean that fewer and fewer people are going to end up being able to qualify because of looking at what happens if you're making a small business loan, which has to vary in terms of interest rate, how long they're going to be able to continue to afford to make those payments. And so I'm very hopeful that the recession won't be deep. And hopefully there's nothing sort of really systemic like the financial crisis that was driven by housing that would drive the entire economy into a very, very deep, deep recession. The commercial real estate crisis or commercial real estate challenges that are particularly with downtown office real estate is a major issue, but it's not as big as, the entire housing market is, suffering like we did, like what happened back in 2008.
A lot of your listeners might say, well, I don't own a commercial office building, so who cares? But if the banks start feeling the pain from that, the banks will pull back and will not be financing all sorts of other stuff as assertively as they were before. And that's where your listeners need to care. Because if the banks start tightening up what they would normally be considering doing because they're feeling the pain on their balance sheet, or Robert, my other concern is it's been enough of a challenge with short-term treasuries at 5%, and the Fed has just indicated now that we're at 5.25% that there's probably two more increases. I mean, how many more times are they going to say, well, there's probably only two more, right? And so let's say we hit 6%. Right? We're not paying 6% on deposits. And it used to be that the holy grail was for a bank building up those non-interest bearing operating accounts. Well, people are fine with that, those business owners. But at 5.5%, 6%, all of a sudden, if they learn enough about sweep accounts and about the idea of why don't I just put it into treasuries earning 6 and I'll do 30-day treasuries and I'll just keep sweeping money back and forth back into the bank to deal with all my operating account obligations. That's going to be an interesting challenge on the banking system as well. So all of a sudden, it's not just about CDs and money market rate. All of a sudden, that DDA, that non-interest bearing deposit account, that's now at risk also as rates keep going higher and that gap becomes greater. So and that will cause banks to pull back. And if any of your listeners happen to be named Jay Powell, my only suggestion would be maybe that everybody pause a little bit and wait to see what the impact is of all that has happened, because it's not instantaneous. It takes time to work its way through. And it could very well be that the fact that banks are pulling back, the fact that there was concern about, a default on U.S. government debt, and rates all kind of bumped up. And now that they've jawboned around another increase in rates, it could very well be that that's enough to have an impact of slowing down the economy on top of the Fed moves that have already been made. So maybe a little bit of patience before doing something too dramatic, would be wise.
Thank you for that advice and for that perspective from the, everything is interconnected. And yes, we need to definitely think about how our actions have a larger impact, right? Okay, I want to end things on a positive note though. Earlier, you gentlemen talked about the importance of having a relationship when it comes to your bank. And I am certain that a lot of our listeners, that's probably something they've never even considered, right? Maybe they think because they don't have hundreds and hundreds of thousands of dollars with the bank, that maybe the bank doesn't care about them, or, maybe they're just starting their business. But I'd like to know, what are your tips for navigating a banking relationship and solidifying one, and how to think about really what the long-term benefits of having a banking relationship are?
Sure. I think the way to approach that is I would start local. I would start with your community and start with the things that you care about. Our bank, Carver Financial Corporation is a bank holding company. We actually own two banks. One is Carver State Bank in Savannah, Georgia, and one is Alamerica Bank in Birmingham, Alabama. And our banks, have a mission. Our mission is to provide the building blocks to financial freedom. And we publicize that mission. We talk about it on our website. We talk about our impact in the community. I'd research local institutions and find the ones that share your values and the things that you think are important. And I would start there. In terms of establishing a relationship, the smaller the bank is, the more likely you're going to be able to establish a relationship with someone. It's kind of a little bit counterintuitive, but if you see an ATM on every corner, it's probably going to be really hard to find a relationship banker if you're a regular person. But if you see a bank that's really in your community and has really been there for a while, or even a new one like Steve's that has a mission to serve and it shares your values, I think I'd start there. I'd walk into a branch somewhere, and I know people don't like to do that anymore, walk into a branch, but I'd try to find a branch, walk in and meet the people and introduce yourself and start, building a relationship, not only in your transactions, but also with the people.
Amazing. Stephen, do you have anything to add in terms of advice for forging new banking relationships and the benefits of it?
Yeah, I'd be so bold as to, take very seriously what you do for a living. Be really prepared, transparent, responsible, and then figure out how to get a hold of Robert James directly, and then go meet with Robert, right? And have the nerve to go do it, but be really prepared and ready. And Robert would probably say the same thing about me. Robert's going to ask you a lot of questions about your business. He's going to want to learn everything about how you do, why you do what you do, how your story got you to where you are today, and where do you want to go? And be prepared for that moment. Be prepared for that meeting. And then Robert is going to make a decision at that moment what he thinks. And then either he's going to stay involved or he's going to hover around and he's going to get a hold of the right bankers inside of Carver. And he's going to put you in touch with someone who's going to look after you and look after your business, because you actually came in prepared and responsible and thoughtful, and you were transparent about it. And that's the way I look at it here at Genesis. If someone has the nerve, to reach out, be prepared, be ready to come in and meet with me, I'm going to find that to be a magical moment, and I'm going to do everything I can to make sure that person is looked after. And that goes on every day. I get emails, I get calls, and all I ask is that that person be as prepared as I'm going to be for that meeting. And there are a lot of people that unfortunately have no idea how to prepare themselves to meet with their bank. It's not as intimidating as it seems like. Just be really thoughtful and responsible and be prepared to be very transparent. And then that relationship can become a very, very, very long-term, meaningful relationship.
Wait, can you just say a little bit more about being prepared? Because you really, really emphasized it.
Yeah.
Are you talking about, having financial reports, bookkeeping team? What are we talking about when you say be really prepared?
Well, you're probably not going to bring your whole team with you or your whole army of people with you to go meet with Robert, right? So Robert's going to want to look at you and see how well you, the person who owns the business, knows your business and has your arms around your whole business. And I think it's incredibly important to make sure that, that's everything from how you're able to articulate your business to why you started your business to where you want to go with your business to what are the challenges, your worries, what keeps you up at night, what can put you out of business, to actually having well-prepared financials, some historical financials, maybe some future projections, and be prepared for that discussion. Because Robert's going to take that meeting very, very seriously. He's not going to come in last minute, not even knowing who you are. He's going to be ready for that meeting. He's a really smart guy. So he's going to look to see how well and prepared you are, how responsible you are, how thoughtful you are, how you're able to articulate that business plan. Because what the bank is also doing is they're partnering with you in your business.
Mm-hmm.
Whether they're lending to you, whether they're advising you, whether they're going to finance where you're going or not, the bank is partnering with you on your business. So the bank is going to take it very seriously.
Thank you for that.
And my feeling is go to the hardest person who's going to make a decision. Ultimately, it's going to end up getting to Robert anyway. So get the meeting with Robert.
Well, see, Steve, one thing about my job title, I became CEO of our holding company back in November, and I used to feel bad because I couldn't understand like what kind of lending authority I have because I'm not actually a lender in either of the banks, so I don't have like sign off authority for loans. And one of the things that's funny about that is now, like when I do speeches or podcasts or interviews or whatever, I'm so glad that I don't have any lending authority because I have to do exactly what you said, which I have to get a person connected to the person who can actually make a decision.
Yep.
It actually protects me from having to say no.
Which is actually a lot more fun.
That's exactly right. But I do ask questions, and if I ask enough questions to feel like the person is prepared, then I'm going to send them to someone in the bank who can really walk them through the details and get them that capital that they need.
Beautiful. Thank you, gentlemen, for coming on Weird Finance and, taking the fear out of banking. I know a lot of people are nervous about, bankers and banking and, feeling like they're being judged. But I feel like you guys have really, brought things down to a level where we can understand kind of the inner workings of a bank and, why it's important to have a relationship. And of course, finding banks where our values in line that have a larger impact. So I want to thank you folks for coming on and taking the time to chat with me today.
Thank you, Paco.
Thank you very much, Paco. It was great.
Weird finance. Weird finance. Weird finance.
This is Stockwatch with Paco de Leon, a former financial planner.
And Amanda Holden, an ex-finance bro and current investment educator.
Over the course of a year, we're going to monitor the stock portfolios of 3 investors.
There's Hank, a terrier mix that looks honestly like a coyote, or perhaps the newest wolf of Wall Street. There's Hugo, a black and white cat living in a world full of color, but hopefully not in the red. And last, there's a human baby.
Each will invest in a total of $50,000 across 5 different stock picks, and we're going to monitor all 3 portfolios.
In the end, there can only be one winner of Stockwatch, and every 6 weeks or so, we'll update you on the competition and teach you about investing along the way. This is Stockwatch.
Amanda Holden, Dumpster Doggy, welcome back for another edition of Stockwatch.
Thanks for having me, Paco.
So I'm taking a look here at the portfolios, and everybody's down a little bit. So let me give you an update. Henry, our beautiful, beautiful terrier mix, has about $46,493 in his account. Hugo, our adorable, furry little cat, is at $48,837. And Rafa, our star, is actually down to $66,324. And as I'm looking at this, Amanda, everybody's down at least a few grand. It's got me thinking about risk. And the last time we were on a high for these folks, because we were mostly on a high for Rafa because he was making a bunch of money. But now we're down. And so tell me about riding the ups and downs of risk.
Sure. And so everybody's down from about a month ago, the last time that we talked. But our baby is still up quite a bit from when we began this exercise. And that's interesting to point out because the market is up probably about 14% since we started this exercise. But what's Rafa up? Like, what's that calculation? Over 30%. Rafa's up over 30%. And then our cat and our pooch are both negative since we started. And so, what we're seeing is risk presenting itself in several different ways. The way in which you mentioned, which is just maybe more the natural volatility of investing in the stock market. It's up, it's down. That's what we mean when we say volatility, is that prices go up and down, especially in the short term. The market can be very dramatic. But also, when we look at the dispersion of their returns, we're also seeing the risk of really what this is showing us is the risk of single stock investing, because each one of our players selected 5 different stocks and they are having radically different outcomes. And so that's risk for you. We are living in the risk. And I actually have an interesting question for you, Paco. What is your risk tolerance?
Ooh, I think I don't have a number to give you or whatever the scale is. I don't know what the scale is, but I think I do have quite a high tolerance for risk. I think being entrepreneurial is a reflection of that. And I often will look at my emergency fund and be like, is that too much cash? Like, I'm mostly that kind of a person.
Put it all in shit coins.
I wouldn't go that far, but
Okay, not that far.
what's your wait? What's your risk tolerance, dumpster doggy?
Well, I was leading you down a path, Paco, because it's a pretty silly question to ask, especially when we don't understand with relation to what that we're even talking about. And it's one of my biggest pet peeves about the way the financial services industry works. Like, let's say you sign up for an investment account on Betterment or any of the robo-advisors. One of the first questions they ask you is, what's your risk tolerance? And it's kind of like medium large,
Exactly.
like 64 ounces. I'll take a big gulp sized amount of risk. And that's why when I teach, what I like to do is start by discussing what specifically are the risks of the different investment categories. And then you can tell me whether or not you want to participate in that risk. And so with the stock market, risk really comes in 2 forms. The first is this short-term up and down volatility. And the second risk is that there are no guarantees for the future. And our game is illustrating this perfectly.
Yeah, we have like a $20,000 differential here, which is bonkers.
Yeah, it's really bonkers. And it is one of these things that you do have to become comfortable with if you want to invest in the stock market. But I also think that it's important to say that single stock investing is significantly more risky. It's inherently more risky than investing, for example, in an index fund that buys you one of every single stock in the stock market. So, for example, if you had purchased a US stock market index fund at the same time that our dog and our cat and our baby picked 5 stocks, you would be up, okay, 14%, you would be up about $7,000 right now. And so, what you'll see is that we've got returns that fall really far on either end. And it's actually kind of perfect because we had one player that is doing much better than that. And we have 2 players that are doing much worse than that, which is actually kind of perfect and really does illustrate the nature of risk. And and maybe it would help to even define what risk is at this point. And what risk is taking some sort of spending risk to try to generate some economic reward. And maybe that reward comes into fruition, but also maybe it doesn't, as we see with our dog and our cat. And so, one of the most important things that we can remember when we are investing is that there is an intrinsic link between risk and reward. Said another way, risk and reward are 2 sides of the same coin. You really don't get to have one without the other. And one of the big ways that this is going to show up in our own investing lives is when we're determining how much money to even invest in the stock market. And let's say that we're doing it in a more broad, fund-based type of way. Still, we have to decide with our money, kind of using like our goals as a framework, our investing timeline as a framework to determine whether investing in the stock market is even right for us. But this big picture decision of whether to invest in stocks or to keep your money in cash or maybe do something kind of in between like bonds, this is really going to be determined by how much risk we want to take in order to generate some sort of economic reward. Does that all make sense?
It makes a lot of sense, Dumpster Doggy. I'm definitely feeling like this very intangible, weird concept of risk is getting a little bit more concrete. So thank you for taking the time to walk us through the intrinsic relationship of risk and reward.
Yeah. And maybe some of those words might be just flying right over your head, and that's totally fine as well. And so I kind of like to think of it in terms of dating. Who doesn't like to talk about sex and dating
Let's
when what
do
they're,
it.
when what they're really talking about is stocks and bonds? And so obviously not everybody lives in a prison of heterosexuality like I do. But I do date men, and so I like to
I'm
use
sorry to
men
hear
at
that, Amanda.
yeah, me too. And so I like to use men as my example. And so imagine I'm dating 2 different men. You know, the first, his name is Steve. He's a really nice guy. No offense, Paco, but he is an accountant.
I'm not an accountant, so I'm not offended by that. Thank
Okay.
you.
Bookkeeper. He is a bookkeeper.
Damn it. Okay. I feel attacked, but that's
Yeah.
fine. That's fine.
Real like Jake from State Farm vibes. Like
Okay.
he's gonna be there when you get home to watch. He's probably gonna make you watch like the Ken Burns baseball documentary, but you're not exactly leaving footprints on the wall every night. And so, okay, so this is guy number 1. Compare him to guy number 2. So guy number 2, so his name actually happens to be Guy. He is the lead singer of an up and coming band. Now, this band could turn out to be the next Nickelback. It could turn out to be the next Rolling Stones. Dating him is a roller coaster. You might have to hawk some t-shirts out of the side of an airbrush tour van, but you could also, Paco, be riding around your Miami Beach courtyard atop an albino tiger while you
Whoa.
light while you light your Newport Slims with $100 bills, right?
From merch girl to millionaire.
Exactly. And so, yeah, that relationship is much higher risk. It might not work out, but it is much higher potential for reward. Whereas the first relationship is lower risk, lower potential for reward. It's just a little bit more predictable. And if you haven't put this together already, what I'm referring to is essentially bonds for guy number one, lower risk, lower reward, and stocks, guy number two, higher risk, higher reward. But the beauty of this scenario is nobody's going to make me get married to either one of these jabronis. And in that way, playing the field, dating is a lot like investment diversification. I keep them both around because sometimes guy number one is what I need. Sometimes guy number two is what I want. And so building a diversified portfolio where you're really diversifying the different types of risks you take, again, is like playing the field or dating around.
I love that. Monday, Wednesday, Friday is your bookkeeper. Tuesday, Thursday, Saturday, and Sunday, it's Guy.
Yeah, that's right.
Amanda
Also-
Holden, this was brilliant. Ladies and gentlemen, if you are listening along and you're chuckling in the car and you're having a great time and you're thinking, my God, this woman makes investing entertaining, well, you would be correct. And so that's why I got to say, if you want more of this, if you want more of these crazy analogies, check out Invested Development, Amanda Holden's investing course, where I think it's all about the yuck yucks. You're going to have a great time, ladies and gentlemen. You won't regret it.
Thanks, Paco.
Thank you for coming on, Amanda. And I look forward to mostly giggling and trying to teach people about investing on the next installment of Stock Watch.
See you in a month.
Take care. Until next time, this has been Stock Watch with Paco de Leon and Amanda Holden. If you'd like to learn more about investing, well, you're in luck. Amanda wants to show you that investing isn't just for Wall Street bros and dusty old dudes. She has a super fun and comprehensive course that's going to leave you feeling completely confident in your ability to build wealth and navigate this overly complicated investing world with all of its terminology. Claim your financial freedom and power. Sign up for her investment education course, Invested Development, today. Head over to amanda-holden.com and click on course, or you can just follow her on Instagram at dumpster.doggy, send her a DM, and she'll get you all set up. Of course, I'll also link to the course and everything else in the show notes. Until next time. Thank you again for listening to Weird Finance. If you like the show, please express that like by giving us a positive review on Apple Podcasts. It really does help us out a lot. And if you'd like to receive even more content from me, you can sign up for my weekly email newsletter, The Nerd Letter. Each week, I'll send you a short email of things I've read and recommend. Sign up for it at thehellyeahgroup.com. Here we are at the end of another episode of Weird Finance, an iHeartMedia production, and just would not be possible without the help of many wonderful, caring, hardworking, and talented folks like my producer, Ramsey Yunt. He produced, edited, did some sound design, and he even sang a little bit on this episode. Thank you to Henry the dog, Hugo the cat, and Rafa the human baby for their help with this week's segment, Stock Watch, our stock competition. And a big, beautiful thank you to Amanda Holden for teaching us all about investing. To learn more from Amanda, check out her course, Invested Development. Thank you to my friend Jess Brona and Ramsey Yunt for lending their voices for this week's PSA. Our theme song was written and performed by me and my dear, dear friends, Jenna Parker and Andrew Parker. If you have any comments, questions about money, suggestions, or you want to be a part of the show, give us a call at 833-ASK-PACO, that's 833-275-7226, or send us an email at weirdfinancepod@gmail.com. That's it. We'll catch you here next week. In the meantime, take care.